Assalamualaikum. A banker acceptor is a short-term debt instrument issued by company. It is guaranteed by commercial bank. It is used in international trade transaction and provide a way for company to receive payment for export good before the actual payment is received from the buyer. So, a banker acceptor is like a promise to pay that bank guarantees make it safe and easy for companies to trade and for investors to earn some money.
Let's explore how the money market operates, focusing on short-term debt instruments, over-the-counter transaction, exchanges, and the active secondary market. The first one, money market instruments. The money market deals with short-term debt instruments like treasury bills, commercial paper, and certificates of deposit. Investors and institutions trade this for liquidity and safety. Over-the-counter and exchanges. Transactions occur both over-the-counter and on exchanges. Over-the-counter allows direct trading with flexibility, while exchanges offer transparency and regulated pricing. For the third one, lending and borrowing, key activities include lending and borrowing funds. Institutions, corporations, and government use the money market to manage liquidity and meet financial needs. And last but not least, secondary market. The secondary market provides liquidity by enabling the buying and selling of previously issued debt instruments, ensuring quick conversion of investment to cash. Let's take a quick look at how the Malaysian money market operates, focusing on key players, instruments, and regulatory framework. For the first one, Central Bank, Bank Negara Malaysia oversees the entire money market, setting monetary policy, regulating financial institution, and managing liquidity in the financial system. For the second one, financial institution, this includes commercial banks, Islamic banks, and the other entities that participate actively in the money market by borrowing and lending funds among themselves and managing short-term liquidity needs. And for the third one, non-bank financial institution, entities like insurance company, pension funds, and asset management firms also participate in the money market to invest surplus funds or manage short-term liquidity. For the fourth one, instruments in the money market. Various financial instruments are traded in the Malaysian money market, including the interbank market, negotiable instrument of deposits, Banker'S acceptance, and Islamic money market instruments like Islamic accepted bills and Islamic negotiable instruments. And for the last one, operation and regulation, Bank Negara Malaysia's operation include open market operation, reserve requirements, and setting the discount rate to manage liquidity and interest rates. The regulation ensures transparency, stability, and adherence to Sharia principles for Islamic financial instruments. In summary, the Malaysian money market is a well-regulated system with diverse participants and instruments, ensuring efficient liquidity management and financial stability.
Issuing bank guarantee payment for transaction on behalf of their client, who are usually importers. They play a crucial role in the banker's acceptance market. The issuing bank intervenes to provide a banker's acceptance, which acts as a commitment to pay the exporter a predetermined sum at a later time when an importer makes plans to buy product or service from a foreign exporter. Buyers, often known as importers, are a company or private person who acquire product or service from overseas vendor. Importers use bankers' acceptance to streamline their transaction and foster confidence with exporter. Business or private person who offer goods or service to customer in other countries are known as exporter. These exporters in international trade have to worry about making sure they get paid after sending their goods.
From features instruments, there are three of them, which is short-term credit instruments, structures, and interest rates. For short-term credit instruments, it is a financial tools issued by a bank that guarantees payment on behalf of the customers. These are designed to make sure of transaction and provide assurance of payment to the customers. For structure, there is a time draft that is drawn on and approved by a bank, and the bank assures that the draft holder that they will be paid on a given future date. It is usually within 180 days. For interest rate charged on Banker's acceptance are typically lower than interest rate charged for other short-term investment.
So I'm going to talk about the three benefits of issuing Banker acceptance. There are three benefits of issuing Banker acceptance. Firstly, risk mitigation. Banker acceptance reduces risks in international trade by hedging against currency exchange fluctuations and buyer payments default through the bank involvement as a third-party buffer. Secondly, the benefit of issuing Banker acceptance is enhanced liquidity. Banker acceptance also offers to enhance the aspect of liquidity concerning international trade among key participants. Banker acceptance boosts liquidity in international trade by allowing holders to sell it for financing before payment, unlike standard trade credit. This is crucial for exporters needing immediate cash flow despite large payment from buyers. Last but not least, international trade is one of the benefits issuing Banker acceptance. Banker acceptance is prudent particularly in enhancing the ease of trade between parties in the trade process situated in different countries. Banker acceptance simplifies international trade with a trusted payment method, reducing paperwork and building trust between buyer and seller, which support economic growth and globalization.
Next, we proceed to benefit of investing instrument. Firstly, credit liquidity. Bankers' acceptance are basically produced by banks with strong credit and established reputation. They are usually used in international trade transaction to facilitate payments. Second, fixed maturity instrument. Bankers' acceptance also can be bought and sold in the secondary market. Market acceptance contribute to their liquidity because there is some seller and buyer willing to trade the instrument. Liquidity provide investors with flexibility to adjust their investment position if the market condition or liquidity needs change. Thirdly, liquidity. Bankers' acceptance has a fixed maturity that helps investors plan and manage their cash flows to contribute their portfolio stability. This is important for any investors that have short-term liquidity. Fixed maturity have a maturity dates that range from a few weeks to 6 months. They provide investors with certainty about when investors will receive the amount invested, including any interest that they earn.
In conclusion, a banker acceptance is a financial tool used in trade where a company promises to pay a certain amount in the future, and a bank guarantees this promise. This guarantee makes a banker acceptance a safe and reliable way for companies to do business, especially internationally. It also provides a way for investors to lend money by buying this promise at a discount and receiving the full amount later.